All right, this is the Cow Guy Close, and I am Scott Schulte, otherwise known as the Cow Guy. And we start today with breaking news from the Federal Reserve. At any minute, they will increase interest rates. The question is whether it's going to be a half a percentage point or 3/4. We've never seen such historic synthetic tightening before. And here's what I mean by that. The Fed is raising rates. Now, that means your floating rate mortgage just went up. Your farm operating loan went up as well. Your credit card interest rates are really going to be going up. But on top of that, fuel is at record highs. Food is up and retail sales are down. Prices right now are 8.6% higher than they were a year ago. Now, assume that they stay the same until next June, right? Well, technically, that would mean inflation would be at 0. But gas prices would still be at $5 a gallon. Food would still be at the same price. Prices today are not going down. Inflation would technically be 0 without prices going down. Now, in my opinion, it just doesn't really matter what the Fed does. And apparently, they've just come out with 75 basis points. So it's 3/4 point hike, and that's what the news is. So please welcome in my next guest, who may have her own take on these things. We were in agreement. We thought it was going to be 50, but I guess we're wrong.
Wow.
Yeah. Well, what are your thoughts on that, and where do we go from here?
Scott, I'm shocked. And all this shows us is that the Fed realizes that they just were too slow for too long, calling it transitory, and now they have to take decisive action. This is decisive. I am shocked. I mean, I only thought we had about a 25% chance of getting 75 basis point hike. So this is shocking. And this lets us know that the Fed sees that inflation really is a big, longer term problem that they need to take aggressive action. Again, they would not have taken this action without data screaming that it must be taken. Wow.
I think that's part of it. I also think that the market was going to give them that too, because there was a lot of folks out there, big bank wise or investment bank wise, that thought that they could do 3/4 point as well. Here's where I stand on the whole thing. You know, does it really matter? I mean, it's an extra quarter in a meeting we thought was going to be a half, but at the same time, I don't think this problem, you can't just do this with interest rates, right? They're basically, Rebecca, it's almost like they're going to have to destroy the economy to get this inflation situation under control, because in order for this thing to go down and go down quickly, that's the only way. You're not going to be able to slow this down by, doing all these interest rate hikes, because everything else is hurting us. Everything else, everything, yeah. Every single thing. So, all right, your operating loan's higher, your credit card loans are higher, those things. Never in my life have I seen this much of a synthetic tightening along with the Fed tightening. What do you think?
You're 100% right. I was just looking at the M1 money supply. So for the audience, that's the money that's in circulation. I was looking at it from the 90s all the way to present day. And Scott, I got to be honest with you, it looks exactly like the S&P 500. That's exactly what it looks like. So in other words, as the Fed has been so accommodative and so stimulative since the global financial crisis in 2008, or we call it the Great Recession in America, since that time, we've been so accommodative. We've not only had low interest rate policy, but we've also had a ton of stimulus. We were continuing the stimulus even through Corona, past Corona. So we bumped it up to 120 billion and the Corona season, that's at 1.3 trillion per year the Fed was giving us, pushing into the economy, I should say. And now we're going to QT. We've switched over this month to go to quantitative tightening. It's about $100 billion plus runoff on treasuries and MBSs per month. So you're right, interest rate policy alone is not going to get this done. But considering that we just started QT this month, it is very surprising to me that they thought that the market could handle 75 basis points. And I'm sure the market's not going to react well. We're going to see probably a whipsaw today because we were obviously to the positive. And I don't think the market prepared for this, Scott. I don't think the market had built this in. I thought we built in 50 basis points. Do you think we're going to see that the market has already built this in? Because this is shocking to me. It really is. With the QT, I'm sorry, I'm a little flustered here because with QT starting and with 50 basis points already being baked in, I'm surprised that they went to this aggressive of a nature. And that really indicates to me that we are expecting more problems ahead. Inflation is longer term, and it is bad on every front. It doesn't give us any good news here. It's really upsetting.
Well, I tell you right now, from the bottom of my heart, take away everything else, I think it's because the market gave them the door to do it. That's why. And they want to be seen to be strong. And so they're going to take the opportunity when the market gives them, because they've passed it up so many times before by talking tough and then not really acting tough, acting dovish. So I think that for this time, I think that that's what they decided to do. And look, if it's not the right thing, and who knows if it is or not, I'm not the world's smartest man, but I definitely think with what I've seen with retail sales, what I'm hearing about job losses, what I'm seeing with job losses, and what I'm seeing with the other parts of the economy, it's not adding up. Something's going on here, and it's not healthy. And I just don't think that the economy can handle this massive, both synthetic tightening and tightening from the Fed, all at the same time. This can go over a period of time. It doesn't have to be all in 3 months.
No, you're 100% right. We've had a 13.4% increase since March, April, and May on an annualized basis for food and energy costs. So that means that, people are probably taking about 20% at least more out of their budgets on a monthly basis to buy their food, buy their gas. And what's happened, Scott, is they've used their savings, they've spent down their savings to cover the extra costs. Now we're starting to see credit card usage
Yes.
jump dramatically. And that's going to be a problem, Scott, because think about it. If they've gone through their savings that fast and now they're using their credit cards, it's not any time until credit cards are maxed out. Then we have people that aren't able to buy anymore. And that is a huge problem for the market.
And they're doing that because I think that they're eating what the government's giving them about we're going to get on top of this inflation and it's going to go away soon. It's not going away soon. So just real quickly, if we don't see prices come off for another year, we're going to look back from next June to this June, and we're going to say prices haven't changed. CPI is technically zero, right? I mean that's simply making it too simple. But then people will say that well, the inflation's down. It's actually collapsed. But we still have $5 a gallon of gas. We still have all these food prices still there. You could see inflation come lower and these prices not change. And I actually think that'll be the case.
And that's awful because that means that we have forever permanently put into our economy higher food and higher energy costs.
Yep.
And that's not a bargain that we planned on having. So
no, I mean, people need to spend more time. They should spend more time now trying to make more money than anything else. That's going to be the only way out for them. All right. I really appreciate you coming on. It was perfect to have you on for this because you and I are exactly alike when what way we think about it. Thank you very much,
Yes,
Rebecca
thank you,
Walser.
Scott.
All right.